In 1990, India and China had almost same economies, same size, same starting line. Fast forward to today, and China is 5 times richer than India. But here's the twist. The smaller one is now growing faster than almost every major economy on Earth, and some banks are betting it will become the world's second largest economy within our lifetime. This is the story of India and China, two civilizations of over 1 billion people each, two completely different playbooks, and one question everyone's asking: can India actually catch up? Stick around because by the end of this video you'll understand exactly how these two giants built their economies, what they sell to the world, who's investing in them, and where they're headed by 2030, 2050, and beyond. Let's get into it. To understand where these countries are going, we need to understand where they came from. Back in 1990, India and China were roughly neck and neck in GDP per capita. Both were poor, both were largely agrarian, and both had just started experimenting with economic reform. China had begun opening up under Deng Xiaoping in 1978. India followed over a decade later, in 1991, when a balance of payments crisis forced the government to liberalize the economy, cut tariffs, and open up to foreign capital. That 12-year head start turned out to matter enormously. China went all in on manufacturing. It built special economic zones, offered land and tax breaks to foreign factories, and plugged itself into global supply chains as the world's factory. The results were staggering. China grew by more than 10% a year in 22 separate years between 1961 and 2024. No other major economy in modern history has sustained that kind of growth for that long. India, meanwhile, took a different road. Instead of leading with factories, it leaned into services, software, IT outsourcing, business process management. Growth was slower and choppier, but it built a different kind of economy, one driven far more by what its own citizens spend rather than what factories export. Today, the gap this created is huge. China's economy sits at roughly $19.5 trillion. India's is around $4 trillion. That means China's economy is nearly 5 times the size of India's. In income per person terms, the average person in China earns about 4.8 times what the average person in India earns. But, and this is the part that gets economists excited, the growth rates have flipped. China's economy is now expanding at around 5% a year, a level that would have been considered a recession-era slowdown a decade ago. India, by contrast, is growing at roughly 6.5 to 7.6%, depending on which quarter and which agency you ask, making it by a wide margin the fastest-growing major economy on the planet right now. So the question isn't who's bigger, it's who's catching up, and how fast. Let's start with China, because its growth story is honestly one of the most dramatic economic transformations in human history. China's model can be summed up in 3 words: investment, manufacturing, exports. For decades, the government funneled enormous amounts of national savings into physical infrastructure: highways, high-speed rail, ports, power grids, entire new cities. State-owned banks lent cheaply to local governments and industries to build this out. That investment created jobs, which created wages, which eventually created a consumer class. But the engine was always building things first, consuming second. On the manufacturing side, China became the assembly line for the entire planet. Electronics, textiles, toys, steel, machinery. If it was made somewhere, there's a good chance a piece of it passed through a Chinese factory. At its peak, exports contributed more than a third of China's entire GDP. That shifted somewhat in recent years. China's leadership has been pushing what they call the dual circulation strategy, relying more on domestic demand while still competing hard globally, especially in higher-value industries. And this pivot is visible in the numbers. China isn't just making cheap toys and t-shirts anymore. It now dominates what people in the industry call the new 3 export categories: electric vehicles, lithium batteries, and solar panels. Mechanical and electrical products alone now make up more than 60% of everything China exports. So who buys all this stuff? Southeast Asia, the ASEAN bloc, is now China's single largest trading partner, followed closely by the European Union and the United States. Trade with the U.S. has actually been shrinking, partly due to tariffs and partly because companies are rerouting manufacturing through countries like Vietnam and Mexico to avoid those tariffs altogether. Meanwhile, trade with Africa, Latin America, and countries along the Belt and Road Initiative has been surging. China is deliberately diversifying away from Western markets. On the import side, China buys enormous quantities of raw materials, iron ore, crude oil, agricultural commodities, the raw ingredients it needs to keep its factories running. It remains the world's second largest importer overall. And here's a number that surprises people. China runs one of the largest trade surpluses on the planet, well over $1 trillion a year. Now let's flip to India, because the model here looks almost like a mirror image. If China's story is build it, then sell it to the world, India's story is closer to grow the middle class and let them spend. Household consumption alone makes up around 60% of India's GDP. Compare that to China, where household spending is closer to 40%. That's a massive structural difference between the two economies. India's big breakout sector was services, specifically IT services, software development, and business process outsourcing, starting in the 1990s and exploding through the 2000s. Cities like Bangalore, Hyderabad, and Pune became global hubs for tech talent. Today, services contribute more than half of India's total economic output, one of the highest shares of any major emerging economy. But here's India's honest weak spot: manufacturing. Despite government programs like Make in India and production-linked incentive schemes designed to build up factories, manufacturing's share of the economy has been stuck at around 14 to 15% for years, well below the government's own target of 25%. Agriculture, meanwhile, has shrunk from around 30% of the economy in the early 1990s to about 16% today, even though it still employs roughly 45% of the workforce. That mismatch, a shrinking share of output but a huge share of jobs, is one of India's biggest structural challenges. That said, there are real bright spots forming. India's semiconductor ambitions have picked up serious momentum. The market is valued at around $38 billion and is projected to nearly triple to over $100 billion by 2030, backed by a $10 billion government incentive scheme. Several fabrication and chip packaging plants have already been approved across multiple states. Renewable energy is another area of rapid expansion, with the government targeting 500 gigawatts of clean energy capacity by 2030. And the digital economy, everything from UPI digital payments to e-commerce to AI infrastructure, is projected to be worth around $1 trillion by 2025, and is only accelerating from there, with companies like Google and Microsoft announcing multi-billion-dollar AI infrastructure investments in the country. Now let's talk trade. India's total exports, goods and services combined, sit at around $800 billion a year. On the goods side, engineering products lead the pack, followed by petroleum products, pharmaceuticals, and gems and jewelry. On the services side, software and IT exports remain the crown jewel, and that segment has actually been growing faster than goods exports in recent years. India's biggest customer is the United States, which buys roughly a fifth of all Indian exports. On the import side, the story is different. India relies heavily on China, Russia, and the UAE. From China, India imports huge volumes of electronics and machinery components. From Russia, it's primarily crude oil. From the UAE, it's gold and petroleum. And that brings up an important, almost ironic point. Even as India and China compete for global economic influence, and even as their political relationship remains tense, China is actually one of India's largest trading partners. India runs a massive trade deficit with China, over $100 billion a year, because it imports so much more from China than it exports back. Overall, India runs a trade deficit of around $300 billion, which isn't unusual for a fast-growing, import-hungry economy building out its infrastructure. On foreign investment, India pulled in nearly $59 billion in FDI in the most recent fiscal year, an 18% jump from the year before. Singapore and Mauritius remain the top sources historically, largely due to how global capital gets routed through those financial hubs, followed by the United States, Japan, and the Netherlands. States like Maharashtra and Karnataka, home to Mumbai and Bangalore, are the biggest magnets for this capital. There's also a geopolitical layer here that's impossible to ignore: the China Plus One strategy. As global companies look to reduce their dependence on Chinese manufacturing due to rising costs, U.S.-China tensions, and pandemic-era supply chain scares, many are looking at India as an alternative production base. Apple, for instance, has been shifting a growing share of iPhone assembly to Indian factories. It's not a wholesale replacement of China yet, but it's a meaningful and growing trend.